Understanding accounting can be a daunting challenge for many people who struggle just to balance their bank accounts. Even in the business world, many managers, executives, and entrepreneurs feel their eyes glaze over when presented with the complex financial statements that represent the lifeblood of their companies. And yet, every decision maker involved in running a business needs to know where their money comes from, how it gets spent, and what danger signs may lie hidden in the numbers. What they need is financial intelligence. In Financial Intelligence, published in 2006 and updated in 2013, Karen Berman and Joe Knight define the term as a set of learnable skills that let you understand and effectively use financial information in your business. They argue that financial intelligence is something that anyone can develop, regardless of background or aptitude for numbers. Berman and Knight also argue that financial intelligence is crucial for all employees, not just those in finance roles, since it allows for better decision-making and a deeper understanding of how your business operates. Developing financial intelligence lets you critically analyze your company's performance, spot potential issues, and make stronger cases for your ideas. Berman, who died in 2013, was a respected educator and consultant in the field of business finance and financial literacy. Knight is a prominent figure in business education and consulting, having worked as Chief Financial Officer for Setpoint Systems and having served as a board member for several other companies. Berman and Knight worked together at the Business Literacy Institute, which Berman founded to help non-financial professionals understand and use financial information. Berman and Knight co-authored several other books, including Financial Intelligence for HR Professionals and Financial Intelligence for Entrepreneurs. In this guide, we'll outline the central components of financial intelligence, starting with how to read and interpret basic financial statements, recognizing that financial reports involve guesses and assumptions, not just cold, hard facts. Next, we'll discuss how to analyze financial data using ratios and return on investment calculations. These tools will help you understand how to interpret data within the broader context of your business environment. We'll also discuss how this book's concepts are commonly applied in the business world. We'll further clarify some of the author's ideas and provide counterpoints for instances when there are different interpretations of financial principles. We'll cover how modern digital tools can shoulder some of the burden of financial analysis, and we'll describe how the book's core concepts can benefit your business, no matter its size. New section, Accounting Literacy 101. Understanding your business's finances requires making sense of different types of reports. Unfortunately, financial statements aren't as straightforward as they may seem. While accounting and finance appear to deal with hard numbers, they actually involve significant judgment calls and estimations by accountants. In this part of the guide, we'll explore the three most important documents that reveal the state of a business's financial health: the income statement, the balance sheet, and the cash flow statement. For every one of these documents, Berman and Knight argue that financial intelligence means understanding which numbers are well supported and which ones rely on assumptions. Accounting practices aim to reveal your business's reality through numbers, but they're also inherently imprecise. Accountants make many guesses and assumptions when preparing financial statements. For instance, they frequently have to decide where to allocate certain types of expenses or how to estimate the useful lifespan of equipment. Their choices affect the numbers, and knowing that lets you interpret financial reports more accurately. Short-form note: Berman and Knight present the traditional approach to accounting used by the majority of businesses today, but in Profit First, Mike Michalowicz criticizes traditional accounting for being so unintuitive that it leads many entrepreneurs to failure. Michalowicz doesn't argue against traditional accounting's math, but he states that traditional accounting methods clash with the way most people think and make decisions. In particular, he criticizes traditional accounting's implied assumptions that profit growth equals success, and that profits should always be reinvested in your business. Berman and Knight don't address these assumptions. Their focus is squarely on interpreting the numbers. In the U.S., the standard accounting rules for business are the Generally Accepted Accounting Principles, GAAP, as established by the Financial Accounting Standards Board, FASB. Berman and Knight point out that GAAP rules provide guidelines for financial reporting, but they still allow for personal judgment. Companies have leeway in how they apply GAAP to their specific situations, which means that seemingly objective financial statements will actually reflect many subjective decisions made by accountants and managers. In addition to GAAP, many companies also use non-GAAP financial measures that sometimes provide a clearer picture of their business performance. However, Berman and Knight state that non-GAAP numbers are not standardized and can be manipulated. Companies can legally use various accounting techniques to make their financial positions look better, and while they're not strictly fraudulent, these practices significantly alter how a company's performance appears. Understanding these techniques gives you insight into your business's true financial position beyond what's shown on its official statements. GAAP and beyond. Berman and Knight aren't blind to the fact that GAAP accounting guidelines are imperfect. Critics of GAAP cite several shortcomings that can mislead investors, such as GAAP's reliance on estimates and guesses that can be inaccurate despite accountants' best intentions. Also, GAAP reporting may not accurately capture the value of innovation in rapidly changing industries. Because of the importance that businesses place on GAAP, managers are often incentivized to manipulate their financial statements to meet financial goals or present a more favorable picture of the company's performance. These issues make it challenging for business leaders to truly understand a company's financial health. Though Berman and Knight are correct to point out that non-GAAP reporting is less stringent than GAAP, and is therefore even more subject to manipulation, it does have valid uses. For instance, non-GAAP numbers let companies exclude expenses that don't reflect ongoing business performance, such as R&D, marketing costs, and non-cash expenses like stock-based CEO compensation. Additionally, one-time costs such as restructuring charges or asset sales can be removed to provide a more accurate forecast of future earnings. Often, non-GAAP reporting lets companies give investors the option to make their own judgments about a business's profitability based on which factors they consider most relevant. The income statement. The first statement to understand is your business's income statement. This is a key financial document that shows whether your company is profitable, but it requires careful interpretation. In essence, the income statement, also known as a profit and loss statement, lists the amount of revenue your business takes in from the goods and services it sells during a specified period. It then subtracts what those goods and services cost to produce, your standard operating expenses, and lastly, your taxes, to show how much profit your business generates. Here, we'll explain what the income statement shows, how it tracks revenue, and the different ways it can account for expenses. While this sample income statement may seem straightforward, Berman and Knight insist that many of the numbers on an income statement involve estimates and assumptions by accountants. For example, in the simplified statement above, the amount listed in sales may include estimated payments that haven't been received yet. Understanding those nuances is crucial for managers to accurately assess their company's performance. Short-form note: at the time of Financial Intelligence's publication, accountants had to interpret data themselves, but today, businesses are turning to artificial intelligence, AI, to make projections and estimates for their income statements. AI can improve a statement's accuracy by speeding up data analysis, reducing human error, and processing large amounts of financial data quickly. AI systems can automatically track transactions and categorize expenses, and by analyzing historical patterns, it can predict future budgeting needs and anticipate revenue. Additionally, AI can help detect fraud and prevent misrepresentations from affecting a business's income statement. One of the trickiest parts of the income statement is determining when and how much revenue to report. Berman and Knight explain that companies can only record revenue when it's earned, typically when a customer receives a product or service. In some industries, this is simple: you record revenue when someone buys a car part or pays for a haircut. However, in more complicated situations, such as building a factory or providing support for an ongoing government contract, determining exactly when revenue should be recorded on an income statement involves significant judgment, such as whether to report it all at the point of sale, or to spread the revenue out over several quarters or years. Short-form note: a variation of the rule that Berman and Knight cite above is the percentage of completion method of recording revenue for ongoing projects. This method involves reporting revenue on an incremental basis, comparing your current income and expenses to the total estimated costs of a project. To use this method of recording revenue, two conditions must be met: your company's ability to collect payment must be guaranteed, and your ability to estimate your total costs, and when your project will be completed, must be reasonably accurate. Businesses that use this accounting method include construction firms, defense contractors, and software development companies with long-term projects. Recording expenses. You also have flexibility in how to report expenses on your income statement. Different expenses may be included in the cost of goods sold or as operating expenses, and the dividing line isn't always clear. Berman and Knight explain that operating expenses are spread out over time, but the cost of goods sold must be reported in the same period as the revenue from those goods. For instance, in the sample income statement above, the cost of goods can include inventory purchased prior to the month it was sold. How expenses are classified can affect key metrics like gross profit, revenue minus the cost of goods, so shifting an expense from one line to another can impact how profitable a good or service appears on the statement. Short-form note: in service industries that don't sell products, the cost of goods sold is often replaced by the cost of services, also known as the cost of revenue. Berman and Knight mention this concept, but don't explain how to calculate it. For instance, it may include the wages of employees directly involved in providing a service to your clients, but not wages that aren't directly tied to the services rendered. Any materials or supplies directly used in providing the service are included, as well as the cost of any subcontractors employed to deliver the service. As with cost of goods sold, any expenses solely incurred to keep the business running are instead listed as operating costs, not cost of services, on the income statement. Berman and Knight also discuss non-cash expenses, such as depreciation and amortization, that have a major impact on reported profits. Depreciation is the cost of a physical asset, such as a building or a piece of equipment, divided across its projected lifetime. Amortization is the same basic concept, but applied to intangible assets such as patents. Companies have discretion in estimating the useful life of assets and how quickly to depreciate them. If your accountants change depreciation assumptions, such as deciding that a fleet of trucks will last 7 years instead of 5, that can significantly alter the income statement's profit line. Therefore, managers should know what assumptions are being used for all their major assets. Short-form note: though businesses can decide how to depreciate assets, in the US they're legally required to depreciate assets in one way or another. However, how to amortize intangible assets is becoming increasingly complex in the digital age, when those assets can include AI algorithms and software that are constantly changing over time. Berman and Knight's financial rules still apply, but estimating the useful lifespan of digital intellectual property is tricky. Some argue that since their lifespans are potentially unlimited, digital assets shouldn't be amortized, but tested regularly to determine if they're still useful. If not, you can write them off as a loss. The balance sheet. The next critical financial statement to understand is the balance sheet, which provides a snapshot of a company's financial position at a specific time. Berman and Knight explain how balance sheets present your business's overall value, what kinds of assumptions underlie your balance numbers, and what the balance sheet reveals about your business that a simple income statement cannot. The balance sheet consists of 3 main sections: assets, liabilities, and how much equity the owners have in the business. The fundamental equation behind the balance sheet states that assets always equal liabilities plus equity. Assets are what the company owns, including cash, equipment, and intangibles like brand names and intellectual property. Liabilities are what the company owes in the form of outstanding debts. Lastly, equity shows what the company's owner's stake is worth. To conceptualize this, think of owning a house. Your asset would be the assessed value of your home. Your liability would be the balance left on your mortgage. Your equity, therefore, is the amount left over how much your ownership of your home is worth. Short-form note: analyzing the balance sheet is the nuts and bolts way to calculate a company's equity, but a shorthand approach used by many investors is based on efficient market theory, EMT, the proposal that a business's stock price always reflects its true equity value. According to EMT, all you have to do is take a company's number of shares and multiply it by the stock price to determine the business's total equity. Whether this is true has long been debated. In his essays, investor Warren Buffett argues that EMT is utter nonsense, and that a company's true value, its owner's equity, can only be achieved by digging through the balance sheet in the way that Berman and Knight describe. Many of the line items on the balance sheet involve estimates and judgments similar to those on the income statement. For example, Whatever methods you use to place value on unsold inventory, depreciate your assets, and estimate payments on outstanding debt will all require assumptions that can significantly impact the numbers. Berman and Knight warn that faulty assumptions can lead to bad decisions or even to disaster, as seen during the 2008 financial crisis with mortgage-backed securities. Short-form note: in The Big Short, Michael Lewis details the financial crisis that Berman and Knight use as an example of assumptions gone wrong. In this case, Wall Street financial institutions made the faulty assumption that mortgage-backed securities bonds that used bundles of home loans to generate revenue were stable financial instruments that would pay off for investors. This proved dramatically not to be the case. In 2007, when the actual value of the underlying loans began to plummet below Wall Street's assumptions, every bank and brokerage that listed these bonds as a balance sheet asset saw their equity plummet as well, triggering the financial meltdown that took place the following year. Reading the balance sheet. While managers often focus primarily on the income statement, Berman and Knight say that investors and financial professionals tend to examine the balance sheet first. This is because the balance sheet reveals important information about your company's solvency and overall financial health. For instance, someone interested in buying stock in your business might look at your balance sheet's equity line, divide that amount by the number of shares, and decide if your stock is priced too high or low. They might also look at how much outstanding debt you have to judge if your business has overleveraged itself to the point that it might risk insolvency during an economic downturn. Short-form note: the balance sheet analysis that Berman and Knight describe is the strategy Warren Buffett used to make his first fortune. In The Snowball, biographer Alice Schroeder writes that Buffett would invest in companies that the stock market valued so low that the stock price was less than the equity it represented. These were not healthy companies, but their assets could be sold off at a profit compared to the stock price Buffett paid to acquire them. Buffett's cardinal rule, however, was to avoid using debt to finance business acquisitions. It was easy access to debt that drove the corporate takeover craze in the 1980s and the subsequent crash in the 1990s, which Buffett personally stepped in to help mitigate. Berman and Knight are careful to be clear that the balance sheet doesn't exist in isolation, but is closely linked to other financial statements. Every change to the income statement impacts the balance sheet in some way. For instance, an uptick in income often increases owners' equity, while selling products at a discount may decrease total assets. Understanding these connections helps you see how your decisions might affect your company's overall financial position beyond what's recorded on your income statement alone. Short-form note: one tactic to adjust the income and balance sheets that's become prevalent in Hollywood is to cancel nearly completed films and take the loss as a write-off. Berman and Knight discuss write-offs as a necessary hardship when a business project fails, but movie studios such as Warner Brothers have canceled several much-anticipated films to boost their financial position. If a completed project is taken off the books, then its expenses no longer show on the income statement, increasing overall estimated profit, nor will the film's projected marketing budget appear as a liability on the balance sheet. The downside, of course, is that moviegoers will never see Coyote vs. Acme, despite the film's acclaim from early screenings. The cash flow statement. While the income statement and the balance sheet give an overview of a business's financial position, taking into account past and future revenue and expenses, the cash flow statement fleshes out the full picture of where a business stands in the present and whether it can afford to pay its bills. We'll explain how the cash flow statement organizes revenue and expenses, what it can tell you that other statements don't, and why it's important to everyone in the business. The cash flow statement shows how much money is coming in and going out in 3 different areas of the business. Operating cash flow shows how much cash the company spends and generates while performing its core business operations. Investing cash flow reveals how much the company is spending on itself in terms of capital assets and investments for the future. Financing cash flow shows how much of the business is funded through loans versus shareholder investments. By examining these 3 areas, managers can gain insight into the company's strategy, its ability to fund its own growth, and its reliance on outside capital. Personal cash flow. The 3 types of cash flow that Berman and Knight illustrate are loosely analogous to the forms of income generation and expenses you may have in your personal life. In Rich Dad's cash flow quadrant, Robert T. Kiyosaki details 4 types of income streams you can develop both in your career and outside it. Though Kiyosaki focuses on earning cash through different channels, each of his methods has associated expenses that you must also take into account, just as a business does on its cash flow statement. Kiyosaki's first avenue for cash is the simplest. If you're an employee, you're paid for your work. This income, plus its associated expenses, such as work clothes and transportation, constitute your personal operating cash flow. This income stream has the advantage of predictability, but steady employment lacks the sense of security that it provided in generations past. Like a business that coasts on standard operations, this cash flow stream leaves you vulnerable to changes in your market or field. The next option Kiyosaki presents is to be a business owner, in which you invest the time, labor, and costs to form a working enterprise and reap the benefits yourself. This is the personal equivalent of the investing cash flow Berman and Knight describe. Just as a business invests in its growth, you can invest in yourself as a business. This cash stream has the disadvantage of being high risk and high cost, but it also has a higher potential for reward. Lastly, you have your financing cash flow. On a personal level, this would include the interest paid on the loans, mortgages, and credit cards you use to fund your day-to-day life. However, from Kiyosaki's point of view, it would also include any wealth you generate as an investor in passive income streams. These include stocks and bonds, as well as income earned from investment properties and other avenues that don't require your day-to-day attention. If you wished, you could conceivably create a personal cash flow statement similar to that which Berman and Knight illustrate for business use. Berman and Knight list several reasons why the cash flow statement provides a clearer picture than profit figures alone, because profit does not equal cash on hand. A company can be profitable on paper, but still run out of cash if it can't collect its debts or if it has large expenses to be paid before its revenue comes in. Also, cash figures aren't as dependent on potentially faulty accounting estimates as profit figures are. Lastly, knowing how much cash you have helps you decide when to take advantage of business opportunities and tells you how much to hold in reserve so you can weather downturns without relying too heavily on external financing. Short-form note: Berman and Knight don't specify how much cash your business should keep on hand. However, in Great by Choice, Jim Collins and Morton T. Hansen suggest that to survive unexpected fiscal shocks, you should carry 3 to 10 times the ratio of cash to assets that other companies in your industry maintain. It may seem that having so much idle cash isn't a good use of a company's resources, but disruptive economic events are inevitable, and having cash on hand serves as a shock absorber, increasing your company's chances of survival. Berman and Knight emphasize that all managers impact cash flow, not just those in finance roles. Sales managers influence how quickly customers pay, bringing cash into the business. Operations managers affect inventory spending, which impacts cash flowing out. Therefore, by understanding the cash flow statement, managers can make more informed decisions that improve the company's financial health and can speak more knowledgeably with executives about the cash implications of various projects and initiatives. Short-form note: making all managers money conscious, as Berman and Knight suggest, is one way to keep them in alignment with your business's overall goals. In The Essential Drucker, management expert Peter F. Drucker says that people who make management decisions now comprise more than a third of the workforce, and every one of these people is responsible for whether their business's efforts produce their desired effects. In your business, therefore, you should make sure that you and your fellow managers keep their monetary goals in mind, and not just the goals of their departments, teams, or projects. New section: Making Sense of the Numbers. Now that we've covered the specific information accountants include on business financial statements, we'll discuss how to interpret and use that information. We'll begin with how to calculate important numbers that reflect your business's profitability, efficiency, and potential to attract investors, with extra focus given to the importance of determining your business's return on investment. After that, we'll discuss how to manage your working capital to increase how much cash your business keeps on hand. Remember, Berman and Knight's main idea is that financial knowledge isn't just for accountants. Rather, they argue that improving financial intelligence throughout an organization can significantly boost its performance. When employees at all levels understand their business's financial aspects, they make better decisions, react more quickly to changes, and contribute more effectively to the company's success. However, creating a financially intelligent company requires more than just a book or a one-time training session. Instead, financial training should be an ongoing process that's part of the company's culture. Training should be customized to your company's specific needs and include a basic foundation for all employees. The authors also argue that in today's business world, where job security can't be taken for granted, employees have a legitimate interest in understanding their company's financial health. Berman and Knight advocate for a policy of financial transparency in which financial information is shared widely and explained. They believe this approach can lead to increased trust and loyalty among managers and rank-and-file employees. That being said, public companies must be cautious about sharing non-public information, but the authors maintain that most financial training rarely includes information that would help a company's rivals. Financial intelligence and transparency. While financial intelligence can improve decision-making, to implement it company-wide may require more than training. It also means giving workers the freedom to apply the knowledge they've gained. In No Rules, Reed Hastings explains how this was put into practice at Netflix. Hastings installed a culture of transparency by disseminating the company's financial data, but he also gave workers the autonomy to make their own decisions and accept the consequences. For this to work, Hastings says you need a talented workforce, a focus on innovation, and a flexible organizational structure. The financial training Berman and Knight recommend could be very impactful in such a business setting. In Reinventing Organizations, Frederick Laloux points out another benefit of transparency: it lets every employee see the organization from the CEO's point of view, including the financial perspective. Keeping information on a need-to-know basis infantilizes workers by suggesting they can't be trusted, whereas trusting workers with financial data lets you make use of the whole organization's intelligence while also demonstrating trust in your employees. When everyone grasps their business's financial situation and feels responsible for it, it generates a sense of ownership that's been shown to increase productivity beyond the financial decision-making that Berman and Knight focus on. Important metrics. To understand which numbers to look at and how to determine what they mean, the authors discuss several key financial ratios that managers, investors, and analysts use to evaluate a company's performance and financial health. Among all the various financial measures, Berman and Knight identify several important financial measures that indicate a company's profitability, efficiency, and overall financial strength. Profitability. To measure a company's profitability, Berman and Knight offer three financial ratios. Gross profit margin: divide the gross profit number on the income statement by the total sales. This tells you how profitable your products and services are in and of themselves. Operating profit margin: first, subtract your operating costs from your gross profit, then divide by total sales. This percentage lets you gauge the profitability of your core business operations. Net profit margin: divide the income statement's net profit amount by your total sales. This lets you assess your overall profitability after all expenses. Berman and Knight recommend that you track these ratios over time to spot trends in your company's profitability. These margins show you how effectively your business generates profits at different stages of the money-making process. For instance, if your gross profit is high but your operating profit is low, then you may be paying too much overhead in day-to-day business operations. With these numbers, you can also compare your performance to business competitors and industry benchmarks. What profit margins tell you? As you track your company's profit margins to measure the factors Berman and Knight describe, investors will likely be doing the same. For instance, financial analysts often use your gross profit margin to compare your business to industry competitors. A gross profit margin that doesn't change much points to effective management and stable product performance, while swings up and down may indicate underlying issues that need attention. A low margin compared to your industry peers signals a need to reassess pricing strategies or find ways to cut production costs. Your operating profit margin speaks to how well you're controlling variable costs that are largely under management's discretion, such as employee wages and how much you spend on rental agreements. Unlike gross or net profit margins, your operating profit focuses on your core business operations, but a low operating profit margin doesn't always signal poor performance, especially for growing businesses that reinvest heavily in expansion. Likewise, mature businesses in stable industries are expected to have higher operating margins. Context, therefore, is very important in judging the significance of operating profit. Of the three types of profit Berman and Knight list, your net profit margin provides the most comprehensive view of your financial condition. It shows how much of your business's total revenue remains as profit after accounting for all expenses. A higher net profit margin indicates that you're effectively managing costs and generating sales, but this metric alone doesn't tell the whole story. It can be influenced by one-time events like shocks to the market or a merger with another business, so you shouldn't rely solely on net profit to determine the strength of your business. Efficiency. To measure a business's efficiency using financial statements, Berman and Knight say to turn to your balance sheet, from which you can assess how well your business is using its resources. For instance, you can measure how quickly you sell your inventory by dividing the average value of the inventory you keep in stock by the cost of goods sold on a daily basis. You can compute how fast customers pay their bills by dividing the amount of money your customers owe by your average daily sales, letting you know how efficient you are at collecting payment for the goods you provide. Finally, you can calculate the turnover rate of all your company's assets by dividing your total revenue by the value of everything your company owns. Short-form note: another way to look at resource use in addition to Berman and Knight's numbers-based approach is to view it in terms of customer satisfaction. In the Personal MBA, Josh Kaufman argues that the more efficient your operations, the better position you'll be in to provide high-quality products and services that outdo your competitors. Therefore, on top of your balance sheet analysis, Kaufman says to come up with a list of both minor and major improvements you can make and prioritize those that will make the biggest difference to your efficiency and profits, in terms of their impact and consequences for your business. The trick lies in recognizing whether your efficiency numbers are good or bad. Berman and Knight explain that this is largely subjective and changes from industry to industry. Nevertheless, you should track your efficiency numbers over time and compare them to industry standards, so you can identify areas for improvement in your business operations. You must also recognize that your efficiency numbers rely heavily on your company's balance sheet and will reflect any assumptions that you or your accountants make in preparing that document. Short-form note: depending on your industry, there are a plethora of standards to grade yourself by that Berman and Knight don't specifically go into, many of which are set by the International Organization for Standardization, ISO. To determine which efficiency standards are appropriate for your company, you can start with quality management standards like ISO 9001, which can improve your processes and customer satisfaction. Environmental standards such as ISO 14001 demonstrate your commitment to sustainability, whereas health and safety management standards like ISO 45001 maximize your workplace's safety. By assessing your company's needs in these and other areas, you can prioritize which standards are most vital to improving your business processes and ultimately increasing your profitability. Investment potential. While managers view their businesses from a different perspective than Wall Street investors, Berman and Knight say that it's important to analyze your financial statements the same way that potential investors will. This is especially crucial if your business wants to finance itself by bringing in shareholders rather than by taking on debt. To make your business more attractive to investors, you need to know what they're looking for and, if needed, find ways to improve your performance in those areas. Short-form note: especially for startups, attracting investors will almost surely be necessary at some point, a process depicted on the reality TV show Shark Tank. Investors on the show use several methods to value entrepreneurs' companies. They start by examining revenue, manufacturing expenses, and other overheads to calculate prospective companies' profit margins. To put these numbers in context, they often compare the startup's metrics to those of their direct competitors. Finally, the investors also weigh intangible factors like brand recognition. If you, as an owner, analyze these factors first as Berman and Knight recommend, you'll have done much of your potential investors' work for them. First off, investors expect to see a business's revenue expand over time. The authors note that sustainable growth rates vary by industry and company size, but consistent growth is key. Another measure investors expect to increase is the amount of earnings per share, EPS, which is the net income on the income statement divided by the company's total number of shares. This is a metric that investors want to see going up even during economic downturns. Also of value to investors are a company's ability to generate cash beyond its operating needs, and how efficiently a company uses its capital to generate returns for its owners. The latter is reflected in the return on investment, ROI, which we'll cover in more detail next. Short-form note: the revenue and earnings growth that Berman and Knight show how to calculate are certainly important to investors, but not every kind of growth is good for business. Sometimes, a runaway success can actually be dangerous, especially for startups. Rapid growth leads to financial strain by increasing a business's operating costs and the size of the workforce it needs, both of which can trigger a cash flow crisis and skew the numbers on your balance sheet and cash flow statement. Additionally, unsustainable growth can cause employee burnout and lower levels of customer satisfaction, undermining your company's reputation. Return on investment. Perhaps the most basic question anyone who invests in a business asks is, will this be a good use of my time and money? In the simplest terms, the ROI answers this by measuring how profitable an investment is compared to its cost. Berman and Knight discuss how ROI calculations involve estimating future business performance, whether an investment will earn back its value, and what the minimum return must be in order for a business or an investment to move forward. To calculate ROI, you estimate the initial cash outlay for a business project and project its future cash flows. According to Berman and Knight, the hard part is to make realistic estimates of how much cash your business will generate, not just theoretical profits. Since determining a return on investment involves making guesses as to future performance, calculating the ROI requires significant judgment and estimation, making it as much an art as a science. However, ROI calculations are useful beyond measuring the performance of your business as a whole. They can also be applied to any new project or venture you create within the larger organization, such as investing in a new product or service. Short-form note: though the process of estimating income is still tricky, AI tools can significantly enhance predictions of future revenue by applying machine learning to historical information, market changes, and customer profiles. By spotting patterns in sales transactions, AI tools can give a comprehensive view of your performance in the market and more accurate forecasts of your future cash flow. Since AI's real-time processing can adjust your revenue projections on the fly, you can update your ROI calculations as market conditions change, rather than relying on old information. Nevertheless, Berman and Knight might suggest you try to understand the numbers for yourself so that you can filter in AI's predictions through your personal judgment. When calculating your return on investment, it's also common to take into account how quickly your investment will pay off. The simplest way to do this is to calculate how long it will take for an investment to recoup its initial costs. While easy to understand, this approach has limitations, since it doesn't consider how money's value changes over time or what happens after the payback period. Berman and Knight prefer a calculation method called net present value (NPV), which is more complex, but provides a more comprehensive analysis. In short, the NPV takes into account that due to inflation, money in the future is worth less than the same amount of money today. The trouble with ROI. Because, as Berman and Knight reiterate, there are so many guesses in making revenue predictions, ROI calculations are often inaccurate due to estimation errors. One study suggests that even small mistakes in predicting costs and revenue can lead to substantial errors in the final ROI figure. The study found that in many IT system projects, cost estimation errors typically fell between 30% and 50%. The level of these mistakes can result in highly inaccurate ROI calculations, followed by misguided investment decisions. The study's author recommends always including an assessment of ROI accuracy alongside your ROI figures themselves to provide a more complete picture for decision makers. Though Berman and Knight prefer using NPV to calculate ROI, even that approach has disadvantages. First, it requires you to estimate future inflation, what financial experts call the discount rate, which NPV analysis assumes will remain constant. However, inflation rates vary widely as economic conditions change. NPV also doesn't account for the cost of the investments you might miss at a later date by choosing one now based on NPV analysis. As with nearly all financial decisions, investment potential relies as much on judgment and experience as it does on running the numbers. To determine if your ROI is high enough, Berman and Knight say you have to decide on your required rate of return. This is the bare minimum amount of return that your business or a shareholder expects to earn back from an investment for it to be worthwhile. Companies set this rate based on factors such as how much risk is involved and what the potential returns are from other potential investments. If a business or a project's projected rate of return exceeds this benchmark, it's considered financially attractive. The rate may vary for different industries or economic conditions, reflecting investors' tolerance for risk and what your financial goals are. Short-form note: for a business owner, the rate of return that Berman and Knight describe will let you decide whether a project or expansion is worth your company's time and money. For investors looking to buy into your business, the rate of return will manifest as growing stock prices and increasing dividends. In The Intelligent Investor, Benjamin Graham divides these prospective investors into defensive and aggressive. Defensive investors are mostly content to keep up with regular stock market growth, but aggressive investors, those looking to get the best returns on their money, usually expect gains of 5% or more in addition to the stock market's regular growth. Whether such expectations are realistic is a subject for debate. Managing capital. Since many of the financial tools listed in this guide rely on guesses and assumptions, it's not hard to imagine how a business might paint a rosy picture of itself by tweaking an assumption here or there. However, Berman and Knight describe a way of using financial numbers to help your company improve its actual performance without increasing sales or bringing costs down. You can do this by managing your working capital, the resources that are readily available, not theoretical or tied up in long-term debt, by adjusting the timing of how payments are made and carefully controlling inventory levels. A business's working capital consists primarily of cash, inventory, and incoming payments, minus short-term liabilities. By effectively managing how it handles capital, your company can free up cash and improve its financial flexibility. Two key metrics that Berman and Knight say to watch are the time it takes to collect on payments and how long you take to pay your own bills. In general, you want to collect incoming payments as early as possible, while putting off outgoing payments as long as you can without angering your vendors. Doing so maximizes how much cash you have on hand at any moment, even without increasing your sales or bringing down your operating expenses. Short-form note: Berman and Knight's recommendation to collect early and pay late is age-old business advice, but there are some advantages to the opposite approach. For instance, some vendors offer better terms, priority service, discounts for early payment, which can result in cost savings over time. Likewise, offering longer payment terms can attract customers, retain their business, and set you apart from competitors. Your optimal approach will depend on your specific circumstances, industry norms, and your relationships with customers and suppliers. Berman and Knight also stress that inventory management is crucial in freeing up cash. While keeping goods and materials in inventory is necessary for many industries, excess inventory ties up cash that could be used elsewhere. The challenge is to maintain enough inventory to satisfy your customers while minimizing the amount of cash it ties up. Managers throughout your company can impact inventory levels, from salespeople placing orders to engineers requesting raw materials, so everyone in the product chain needs to know how they add to or subtract from working capital. Short-form note: in a mid-sized to large business, Berman and Knight's advice not to tie up too much cash in inventory applies, but for small businesses, there's sometimes a risk of being low on inventory just when you need it. In 12 months to $1 million, Ryan Daniel Moran says that running out of your product can be disastrous for a startup. It cuts off your revenue, destroys your sales momentum, and loses customer engagement. If your product becomes suddenly popular and your sales go up, you might run out of stock and be unable to fulfill all your orders. Berman and Knight conclude that even small improvements in capital and inventory management can result in more cash for your business, so a little financial intelligence can go a long way toward your company's success. Short-form note: the smaller your business, the more important it is to manage your capital well. In Innovation and Entrepreneurship, Peter F. Drucker writes that a lack of robust financial controls can doom even the most promising startups, particularly those that grow too rapidly and can find themselves starved of much-needed funds. Drucker also says that as your business expands, it will outgrow its initial funding method, possibly making you bring in new partners or offer stock to the public. The capital management skills that Berman and Knight suggest you develop can help you estimate your business's future needs and set them in motion today.